Laurie Calvasina, how important is this conversation for you, the tapering conversation that people seem to be addicted to over the last couple of months?
I think the tapering conversation is key, but frankly, I think the damage was already done after that June Fed meeting when equity investors dramatically pulled their timetable forward on when it would actually happening. So I think that we've been seeing gyrations in the markets and repositioning in terms of sectors because of that for quite some time. To me, the bigger conversation, frankly, is when do the hikes actually start, which we think is going to be next year. But I think that's really the more important one to be looking at, because we know that there are sort of discrete impacts that always happen. We tend to see GDP cool after hikes are over. We tend to see multiple compression or flattening. We do tend to see things like ISM peak. We do tend to see all of the reflation trades flip. So to me, that's the bigger conversation. I know there's a lot of talk about tapering, but I think a lot of investors I speak with have already digested that to some extent.
Let's talk about the rate story then. Tobias, do you think we will be successful navigating this path forward where we can aggressively de-link any call on tapering away from any guidance on rates?
Probably not. I mean, the tapering discussion is really setting the stage for future rate hikes. And in fact, we because of the kind of distortion of the Fed in the markets today, we look at inflationary data to kind of look at the multiples as opposed to bond yields, because one of the offsets to bond yields are potentially much higher equity risk premiums. If the Fed is determined, and not just the Fed, but central banks globally kind of tell you we must keep rates low in order to generate durable, sustainable economic recovery, they're also telling you there's a lot of risk out there if we don't. So I do think the bond yield discussion is less important than the inflation one. And even at 2-3% inflation rates, and we're above that currently, but even at 2-3, the kind of multiples you typically see on the market are 18 times, not 21, 22 times.
On the inflation story then, Tobias, really important question. Do you think the sticky inflation will be sticky? Sufficiently so that it could overwhelm the goals of this Federal Reserve and whelm the multiple of this equity market?
My opinion doesn't really matter that much. I don't have that much impact on the markets. But one of the things we do look at is what our clients are telling us. The survey we did late June, 56% of clients believe there were more 12-month type inflation, and only 32% believe that it was going to be more transitory, 3 to 6 months. So clients believe that inflation could be more of a problem, and they're the ones managing the money.
Erin Browne, you don't agree. I know you think a lot of this is going to be transitory, don't you?
I do. I do think that we're going to remain with inflation at higher levels than what we've seen over certainly the last 5 to 10 years for the next 12 months or so. But I do think that the Fed will look through this and realize that a lot of these issues are either supply constraint driven or pandemic driven, and therefore they are transitory in nature. So expect higher inflation for the foreseeable future, but not high enough to really change the path of the Fed. What I would say also, just back to the earlier discussion, what I think is going to be really key for the market is not when we taper, whether it's September or, the end of the year or early next year, but ultimately the real conversation is what is that R star going to be? What's the ultimate landing point for rates in the future? Because that ultimately is what's going to drive future equity returns per Tobias's comment. So I think not only, the timing, but more importantly, the pace and also the ending point for rates is really going to be key to understanding sort of the future path for equities from here.